Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel and want to hear more about personal finance and worth the money videos, please subscribe. In this video, I'm going to be talking about how to read a life insurance quote or illustration and things to look out for that you might not have thought about. Let's get started. Let's go over some basics of how to read different types of life insurance illustrations, how you can tell different products apart from each other, and what to look for when looking at different types of quotes from different insurance companies. Every life insurance product designed in the same way with the same variables should look fairly similar, but with slightly different values based on each company's unique pricing. Something that can get easily overlooked on illustrations but drastically can impact the pricing of the policy and illustration values is the tobacco rating and health rating. Both of them will be displayed on the ledger pages, the ones with all the columns, either at the top or the bottom. The health ratings will use slightly different terminology like ultra preferred, premier, or standard depending on the carrier. But make sure you're looking at a fair comparison on the illustrations being shown to you. An easier way to think about this is the best health rating, the second best health rating, and the third best health rating, and making sure that all illustrations are at the same equivalent health rating. Tobacco ratings are straightforward. It's either tobacco or non-tobacco, with no in between, which are generally labeled as either T or NT. If you want to understand a bit more about how each of these products work in even more detail, please check out my videos on common life insurance products and universal life insurance products, which I'll link at the end of the video and as a pinned comment. Starting with the two easiest life insurance illustrations to read because they have the least amount of information on them are term insurance and GUL, or guaranteed universal life, because they really only have about three major values on them: the death benefit, the annual premium, and how long the coverage lasts. GUL also has a cash value, but the cash value drops to zero within a few years of taking out the policy usually, so it's not relevant. In the death benefit column on both term and GUL, the death benefit amount will cover until a specific age. On term, it will cover either 10, 15, 20, 25, or 30 years, or until age 80. GUL, depending on how long the guarantee is run for, can be anywhere from about age 90 to age 120. There should generally be an asterisk or arrow symbol next to each year based on how long the guarantee lasts for GUL. The premiums for level term insurance should extend until the end of the coverage period. So if it's a 20-year policy, there should be premiums for 20 years. If it's annually renewable, they will extend until the coverage ends around age 80, but be increasing each year. For GUL, the premiums can extend as short or as long as initially designed. So the policy can be paid in a lump sum, 10 years, 20 years, something in between, or extend for the lifetime of the policy. That's based on what your financial advisor or insurance agent designed for you in the illustrations, and should be based on what you can afford. For whole life insurance, you'll have a few more values to keep track of, in addition to the annual premium and death benefit. The additional ones would be guaranteed cash value, non-guaranteed cash value, non-guaranteed distributions if there are any, and paid up insurance. As you'll see on this 10-page illustration, I highlighted a number of columns and values, particularly the cash values on the non-guaranteed side. So typically an advisor or insurance agent will talk to you about the non-guaranteed side, but in reality, the actual values you'll get for your policy will be a little lower than what is shown on the non-guaranteed side, but higher than the guaranteed side of the illustration, essentially somewhere in between the two sets of values. The reason for this is because these values are dependent on a combination of your annual premiums and the company's performance and internal rates of return to be able to support the increases in values for their policy holders. The reason I highlighted year 18 is because some advisors like to illustrate that the cash value can be withdrawn as a loan to help pay for college tuition. This would be on the supplemental non-guaranteed pages because it is an alternative version of the standard illustration with changes or distributions. The paid up column typically is less relevant for 10-pay illustrations, but essentially on 20-pay, pay to age 65, pay to age 100 illustrations, where the payment period is much longer, the paid up amount will be less than the total death benefit until the payments end. You can see on this 10-pay that in year 10 and after, the paid up column matches the total death benefit. Going paid up on your policy is basically saying to the insurance company that you no longer wish to make payments into the policy and are willing to accept the limited death benefit and cash value that the premiums you have paid into the policy up until that point will purchase. Do not go paid up in year 7 or earlier, as that can mech the policy and make your cash value distributions from the policy taxable, which negates one of the main benefits of owning a whole life insurance policy. MEC stands for Modified Endowment Contract, which is a designation given to cash value life insurance policies that have exceeded legal tax limits. MEC status changes life insurance from being treated as a life insurance policy to instead being treated more like a taxable investment. So in general, it's best to avoid MEC status unless you are only buying the policy 100% for the death benefit only. For universal life illustrations, the key things to look for are whether it really is just a traditional current assumption UL without being an indexed or variable universal life policy, and the death benefit option. The death benefit option may indicate whether it is a current assumption UL because it is generally type A or B. IUL and VUL tend to be type B, but can also be type A to lower the annual premium. There should also be no real mentions in the disclosure pages about any investment options for current assumption UL. Another best practice is also to see if there is any type of guarantee for the death benefit and the age when that ends. Look for this on both the non-guaranteed illustration pages and the guaranteed values, particularly for IUL for guaranteed death benefit. Most UL policies do not have a guarantee unless it is a GUL. Guarantees are always subject to all premiums being paid in full and on time from the perspective of the insurance company. If it does not specifically say guaranteed death benefit or GUL anywhere without any abbreviations, it's likely not going to be a GUL. If you see anything that says current assumption UL or cash value accumulation on the ledger pages, which are the ones with all the columns, then it is typically a normal current assumption universal life insurance quote. Some advisors or insurance agents may not be that specific with the exact universal life policy that they're presenting or sending, so distinguishing between the UL products is valuable to know what kind of coverage you're reviewing. Here is a breakdown of all the different UL products. For more details on each of these universal life products, check out my universal life insurance products video. If you are being shown an indexed universal life insurance illustration or are not sure exactly what type of policy it is, make sure to look for these three things in the beginning part of the illustration to confirm it's an IUL policy. Cap rate, floor rate, participation rate. Participation rate is the percentage of positive index movement credited to the policy. So if the selected index increased 10% and the IUL had an annual participation rate of 70%, the policy would receive interest credit of 7% on the policy anniversary. Participation rates on IULs today range from 45% to 160%. There are also uncapped choices occasionally, which offer no limit on the maximum crediting interest rate, but the trade-off is a lower than 100% participation rate in the return of the index, such as 60% or 70%. Uncapped versus high participation. They trade off with each other. The uncapped has lower participation rates, and the higher participation generally has lower caps. Roughly speaking, they are fairly close in terms of performance. The uncapped option has a slightly better chance to outperform the capped option only if the returns can typically exceed 15 to 17%. These three things are usually specific to indexed universal life, though some variable universal life illustrations have them as well since the investment choices have expanded. If you want to understand how 1 year point-to-point works for calculating returns against the benchmarks, please check out my 2 videos on life insurance products for indexed universal life and whole life. The guarantee age for coverage does not have to last until age 120 on IUL. It can be illustrated to last only until age 100 or 110 or even lower if you choose. Like on other universal life products, the premiums can be fairly flexible and can last however long or short your budget allows. Again, if the guarantee is set for a specific age, you cannot miss paying premiums, otherwise it will impact the guaranteed coverage age of the policy in the future. IUL illustrations should also not be run at higher than 7% benchmark returns to not overinflate potential performance of either the cash value or death benefit. VUL will be very similar to IUL, but illustrations will less likely have a cap and would be more focused on investment return. To be conservative, just like IUL illustrations, VUL illustrations should be run at 6 or 7% return to not overinflate the growth in cash value or death benefit in the future. Depending on the investment choices selected, They could even have a participation rate. Rarely would they have a floor, if at all. If you're not sure whether the illustration is variable or indexed universal life, check the name of the product on the title page. It should give you an idea as to which product it is and could read something like Variable Universal Protector or VUL or Indexed Protector for IUL. Check to see if a guaranteed death benefit is available depending on the state that you plan on purchasing the policy in. If you decide to choose indexed investment choices within VUL, find out the details behind the participation rate, performance cap, floor, if there is a floor, and whether 1-year point-to-point crediting is used. I explained extensively how 1-year point-to-point works in my Universal Life Insurance Products video, so check that out if you haven't already, or need more details on how it works. Other than these caveats, VUL should feel fairly similar to looking at a whole life policy without as many guarantees, but with more focus on investment options and rate of return. If you want to know what assumptions either a financial advisor or insurance agent used to create any illustration, ask them to send you the full illustration, which should be a minimum of 10 to 12 pages, but will likely be about 20 to 30 pages, which will include all the disclosures, terms and definitions, and non-guaranteed ledger pages. Often they will only send you the ledger pages with the columns that they want to show you, so you only focus on what they want to discuss with you. But the full illustration will have supplemental pages at the end that are called input pages, which details every assumption and input that can be used to recreate that same illustration or to figure out why the values of an illustration are coming out a certain way. Always check the guaranteed values pages to confirm if any death benefit guarantees would be impacted due to the insurance company lowering their rates or returns. On the non-guaranteed pages, check whether any minor changes like premium adjustments, loans, cash values get impacted by other variables in the illustration like rate of return, duration of premium payments, amount of premium payments, and if any outflows from the policy could cause it to potentially lapse in the future. It probably is a good idea to get a minimum of 2 or 3 illustrations from 2 or 3 different life insurance companies of the equivalent product type for price comparisons and to see if the values are any different for death benefit and or cash value. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.